sir. I just wanted to be sure we have. Why? Okay, I think. Can we please start in the next 3 minutes? We should probably give people a 3 minutes grace for them to join the meeting so that we can start proper.
That'll be
So
fine.
please, can we just have a 3 minutes grace so we can start proper?
That'll be fine.
Meanwhile, while we are waiting for others to join, please, you can try and turn on your video, and let's be sure that everyone we're seeing our faces. You can please turn on your video. Can everyone just unmute and say good evening so we can be sure that everyone can hear us? Good evening.
Good evening, everyone.
Good evening, everyone.
Good evening, sir.
Good evening, everyone.
Good evening, everyone.
Good
evening, everyone.
Good evening, everyone.
So that's good. So please let's do well to make sure whenever the speakers are online, let's make sure we have our audios being mute so we'll be able to hear them clearly. In the next 1 minute, it's very, very important. Please at all time, let's make sure it's muted. Whenever we have any question or whatsoever, please let's do well to make use of the comment section, like the chat button. We can always use that so as not to interrupt the speaker. I'm sure we are all eager to tap from the wealth of knowledge from our great speakers tonight. And in a couple of seconds, we'll be having the opening prayer where we can then start proper. Others will probably join us on the line because we really have to make proper use of our time. So without me calling names, anyone led by the Spirit, can anyone help us with the opening prayer?
Shall we pray?
Help us with the opening prayer?
Okay, my name is Wale Akpata. Let's pray. Can we all hear me?
Yes, we can hear you, sir.
Yes, we can hear you, sir. Mr. Wale.
Our Most High God, we give you praise and honor. We appreciate you for this opportunity that you have given to us to learn. Lord, we commit this session into your hand. We ask that you will take over in the name of Jesus. Lord, we pray for the speakers, that your knowledge, your wisdom, the in-depth, oh Lord Father, will be released through them, and we'll all be blessed and be impacted even through these sessions in the name of Jesus. Lord, go with us as we go and end it well with us. In Jesus' name, we have prayed.
Amen.
Amen. Thank you very much, Mr. Wale. That was a very quick one and very brief. Thank you very much, sir. You're welcome to this program. So very quickly, I would like to reinstate for those just joining, please, as I call on the first speaker, let's make sure that our mute button is actually active, please, to avoid any form of distraction. Let's make sure that we are muted because I'll be bringing up our first speaker. So our first speaker is going to be Mr. Aino Joseph Tunji. So I'm going to give his profile so that we can know who is the man that is about to give us pour on us tonight his wealth of knowledge. So Mr. Aino JT from Okeokun Town in Kwara State, Southwestern, is a 1999 graduate of accounting from Kwara State Polytechnic, Ilorin, Nigeria. He had his National Youth Service Corps with the Church of Nigeria, that was the Anglican Communion in Calabar, Cross River State, in the year 2000 and 2001, as a part of his humanitarian services to his God and humanity, and where he pioneered a nursery and primary school for the church in 2000 and 2001, and now a fully developed secondary school of 25 years later. AJT, as is popularly known, started his professional careers in 1997 with Messrs. Olushola Adekonola and Co., Chartered Accountants in Ibadan Zone, for his IT, which we all know as Industrial Training Program. After his NYSC program, he joined Mesa Azan Nakapodia and Co. Chartered Accountant firm, Mesa Adeniji Agbola and Co. Chartered Accountant firm, and Mesa J. Ajayi Patunola and Co. an estate surveyor and valuers firm. AJT is a member of several professional bodies in Nigeria, which is not limited to fellow member, the Institute of Chartered Accountants Nigerian, known as ICANN, a full member of the Institute of Strategic Management of Nigeria, ISMN, associate member, Nigerian Institute of Management, NIM, associate member, Certified Pension Institute of Nigeria, CPIN, associate member, Equipment and Leasing Association of Nigeria, ELAN, associate member, Business Recovery and Insolvency Practitioners of Nigeria, ABR, and is currently running his MBA with Nexford University, USA. Trust me, is versatile in audit, taxation, business recovery, and management consultancy. He is a regular paper presenter in finance-related courses with many professional bodies and corporate organizations. He is an accredited facilitator with MAN, which is a Manufacturer Association of Nigeria, and other. He is also the managing partner, Tunji Aino and Co., which I'm sure we've been seeing all over Lagos. They are chartered accountants, and is also the lead consultant in IC Pro Professional Services Limited, which is a business and compliance consultant. AJT is a God-fearing man and also a pastor with the Redeemed Christian Church of God. He's married and blessed with children. Ladies and gentlemen, please let's explore our mind and join me welcome our first speaker for tonight, Mr. Aino Joseph Tunji. Over to you, sir. You're welcome, sir.
Good evening, sir, and good evening, everyone. Good evening, the president, members of the council, and the members of the institute, and everyone who join us from different walks of life and industry and profession. And I can guarantee you tonight, within a short period that I have, I'll be able to do justice to the practical aspect of this session. Now, I will not be sharing my slide. Actually, I've sent it to the coordinator, but because the second speaker will be speaking mostly on the reform which are prepared alongside, so I have to suspend it. Though I've sent it to the coordinator, but permit me to speak without sharing. And I've asked the coordinator to please record this session, which I've seen it being recorded. So I'll be speaking on the practical aspect. Let's start by saying, how do you start your journey with FIRS, Federal Inland Revenue Service? Since we'll be looking at the FRS, which will soon become Nigerian Revenue Service from 1st of January 2026. But for now, I'll be using FRS and State Internal Revenue Service. So your journey with FRS starts with registration with FRS. And what does the Act say? The Act says that when you register your company with Corporate Affairs Commission, you must, of necessity, register that company within the first 6 months of your registration with CAC. Even whether you have started or not, FRS want to know whether your company is a 16. So the law says that if you fail to register within the first 6 months of your registration of that company with FRS, you have violated the law, and you'll be penalized for late registration. So that is your first journey with FRS. Then what are the registration requirements or process of your organization, whether it's a business name, whether it is an NGO, whether it is a religious body, whether it is a limited company, whether it is partnership, whether it is a PLC or holding company. The first thing is to apply to FRS by giving them all the CAC documents. And the application will be done on your company's letterhead. And there's a form called Tax Promas form, Tax Promas update form. So all your, there are requirements that you need to fill on that form. So when you fill it, the information will be keyed in into their system, and a login detail called Tax Promas login detail will be generated for your company. And what is the importance of Tax Promas login detail? It helps you to be able to access everything about your company as related to Federal Inland Revenue Service, whether the VAT, whether the withholding tax, whether the company income tax, whether late submission penalty. So everything is contained on the Tax Promas. The next thing we need to look at, what are your obligations? What are your responsibility for registering your company with Federal Inland Revenue Service? Once you register, you become a collection agent for FRS. And if you fail to act based on the law and to represent your principal, which is the Federal Inland Revenue Service, then you'll be penalized for not doing so or for not doing so. So let's start with VAT. VAT added tax, which is value, the tax that you pay on value addition. If you are receiving any product that no value is added, you don't need to pay VAT. Look at Roya, plantain that is just being bought in the market, open market, or you've gone to the farm, you purchase it. You're not going to pay VAT on it. But when that plantain is either roasted or fried, packaged, and put in supermarket, value has been added to it. Therefore, you will pay VAT on it. You know, it is also food. We have cassava flour. We have yam flour that you can use as pando. Ordinarily, you don't supposed to pay because it is food element. But because it has been processed and value has been added to it, gotten NAFDAC number, label, preservation, and it can last for months, even some for years, you will need to pay VAT on it. So the rate is still the same thing, 7.5%. The VAT rate is still retained at 7.5%. Now, you must understand the VATable products and those products that are exempted. If you don't understand them, somebody will be charging you VAT and you'll be paying. Any food, especially in raw state, agro products, baby products, sanitary, education, health sector, NGOs, religious body, they are exempted from paying VAT. So if you work for such an organization or you run such an organization and you are patronizing someone and that person wants to be charging you VAT, you will tell the individual, I am VAT exempted. The next thing you need to look at is VAT input. What is VAT input? VAT input is every VAT you pay at the point of making your product or offering your services. Currently, VAT paid on service provision is not allowable. You can't claim VAT input on any professional services or services that you have offered. But the government has been so magnanimous that from next year, as a service provider, which I believe majority of us fall into, you will take note of the VAT that you have incurred in producing those services. So you can make an input VAT claim if you are qualified to pay VAT or to remit VAT from next year. Then we need to look at the e-invoicing. One of the things the NRS will be doing next year, that's the Nigerian Revenue Service, is to go digitalization. And what they are trying to do is when you are invoicing, they want to receive a copy of that invoice directly. So this one will involve high level of technology and internet facility because it must be done real time. Another thing we need to look at is VAT filing on tax promise. Gone are the day that you will be going to tax office. I remember in those some years back, before the advent of 2020, yeah, we have several clients that we are consulting for, and we need to be visiting tax office on regular basis. And sometimes when you visit the office, they will tell you the individual that is in charge of assessment or collection or RPP or the tax controller is not around. So you'll be wasting your time unnecessarily. So everything you need to do with FRS and NRS going forward can be done at the comfort of your bedroom, your office, via the tax promise login detail. Then what we need to look at again is penalty for non-filing. What does the law say concerning VAT filing? The law says that you must file your VAT. That is if you are qualified to collect VAT or you are qualified to pay VAT. If you collect VAT, you will need to remit on or before 21st of the following month of that collection. If you fail to do that, the law says for the first month is 100,000 naira and subsequent month is 5,000 naira penalty. And you know, when they are calculating their penalty, let's assume that you fail to remit for the first year, that's 12 months. The 12 months will be giving you like 650,000, 550,000 naira, 10% penalty and 21% interest. So on that single year that you have incurred, you will need to pay like 31% penalty. But you can avoid all this hassle by filing your VAT adequately. And the law says that it is not until when you are qualified to pay in cash, that is where you should file. You must file even if it is no return until you are qualified to pay. File your returns on or before 21st of the following month regularly. If you default, the first month is 100,000 and the subsequent month is 50,000 naira. So let's move to company income tax because of our time. Every registered company and a corporate organization must file company income tax, which is called annual returns. And the law says that you must file your annual returns on or before the first 6 months after your accounting year end. For example, if you make up your accounting year end as at December 31st of each year, the law says on or before 30th of June, you must file your annual returns with FRS. Failure to do that The first month you will incur 100,000 naira, and subsequent month is 50,000 naira. So let us assume somebody plays ignorant, or somebody just refuse to comply with the tax law, and throughout the whole year, he failed to file VAT. Throughout the whole year, he failed to file his annual return, which is company income tax. By the time they raise the liability for the two elements and imputing penalty and interest, at the end of the day, the whole thing may be going to like 2.5 million, whereas you will not pay anything if your turnover is not up to 100 million. You only just need to file nil returns. Irrespective of your turnover level, you must still file your annual returns. We are all aware that if your turnover within accounting year is not up to 100 million naira, you are categorized as a small company, and you are not expected to pay VAT, and you are not expected to pay company income tax, you are not expected to pay education tax, which has been reformed or redefined as development levy. So I will still speak on that later. So what are the provisions? Okay, one of the reasons, or some of the reasons why your computation, your tax computation may not be the same with the tax officers. Number one, provisions. Number two, deviation from tax rules or tax laws. Inclusion of disallowable expenses. Wrong use of wrong rates. The next one is commencement rules. Commencement rules have been abolished. Before, we have commencement rule that follow three rules. Number one, your commencement day up to the 31st December of that particular year that you started. Then the second rule has to do with 12 months, the day of commencement to the next 12 calendar months. Then the third rule is the next year from January to December. But all this has been abolished. So when your auditor is preparing your account, if you start your company within this year, for example, year 2025, and you start in October, you start in June, the law says that your account must be prepared within that year. If it is 4 months, if it is 6 months, if it is 12 months, prepare it and declare what you're supposed to pay. If you have nothing to pay, file it and make it a nil report. Then capital allowance too, going forward from the year 2026, it has been harmonized. There is nothing like initial allowance or annual allowance again. Annual capital allowance is capital allowance, and it is being applied on straight line method. So it is like it's following depreciation. For example, depreciation is on straight line method. So if capital allowance is being done on straight line method also, then it follows the same rule like that of depreciation. And you know, capital allowance is what you charge against the accessible profit before you determine your final tax to be paid. It is also tax incentive on capital expenditure. I spoke about development levy. Under this current regime, we have something that is known as education tax, Police Trust Fund, NASENI. But now the government says they want to avoid all this ambiguity, and they want to consolidate all these reports, all these calculations on a single platform, which is known as development levy. A development levy rate is now 4%. So I've spoken about penalty, which is the same thing like that of the VAT. there's something known as tax holiday. There are some industry that will enjoy tax holiday. Before now, we have been having pioneer status incentive, PSI. What does that one say? There are some industry that are given the privilege for the first 3 years of their operation, commencement of business, they will enjoy 3 years tax holiday. And after that 3 years, they can apply for another 2 years. But going forward from 2026, that one has been changed to economic development tax incentives, which has a little modification from that pioneer status. Then let's look at the withholding tax. Withholding tax is the tax you pay in advance. The government, they are very, very wise, or those people that came up with this withholding tax, because they want to make sure that no one escapes tax payment if they are qualified to pay tax at all. So how does this apply? Withholding tax is applied on different elements with different rates. For example, rent suffers withholding tax. Dividend suffers withholding tax. That is why they call it withholding tax on frank investment. Director fees suffers withholding tax. Professional services suffer withholding tax. Supplies and contracts, all these attract withholding tax. Application of withholding tax credit notes. Now, when, for example, if I am offering you a service, the law says that when you are paying me as a professional, but there are some exemption. I'm still going to come to exemption. The law says when you are paying me as a professional, a service provider, your vendor, you should deduct 5% from my professional fee. And when you deduct it, because I'm a business name, I'm an individual, you will remit what you have deducted on my invoice to the state internal revenue. So if it is Lagos, you will remit it to Lagos State Internal Revenue by using my payer ID. My payer ID. But if I am a limited company offering you services, the law says that when you are paying me, you will deduct 5% of that invoice and remit it to Federal Inland Revenue by making use of my tax identification number. When you pay when I suffer withholding tax as an individual or a limited company, when I am to pay my tax liability, I haven't computed it. The law says that the withholding tax I have suffered, whether as an individual. Sorry, can you hear me?
Yes,
Yes, we can hear you.
Perfectly.
We can hear you.
Yes, sir.
Go ahead.
All right.
We can hear
The law
you.
says, all right.
We
Thank
can
you so
hear
much.
you.
Yeah, the law says that withholding tax I have suffered as an individual, if I want to pay my tax, personal income tax to Lagos State next year or whichever state that you belong to, you will deduct that withholding tax because it is tax paid in advance. And the same thing is applicable to limited companies. So when the limited company prepare its audited account and tax computation have been arrived at, whatever withholding tax that individual, company had suffered will be net off against that tax liability. So on the tax promise, there is a portion there because as your client is deducting the withholding tax and they are remitting it on your behalf, is being credited to your account. So when you had uploaded your tax position on the tax promise, it will give you the tax liability, and it will ask you, do you want to use withholding tax credit note to offset your liability? Once you say yes, it will deduct it. So if you have a non-withholding tax to your credit or your tax promise, then that means you will be able to offset all the tax liability and you'll still be able to have in excess. But if you have a shortage of withholding tax below that tax liability, once you click in, it will pay part of the tax liability and you will use cash to offset the remaining balance. Withholding tax exemptions apply on real estate investment. The law says that when a real estate investment company, so whichever questions we have, we'll be asking later. Now, the law says that that's the news concerning the real estate investment company. When a real estate investment company invests in real estate investment scheme, the law says that when the real estate investment company is paying the dividend to the shareholders, that they don't need to deduct dividend again. They don't need to pay they don't need to withhold on their dividend again, so that it will not suffer double taxation, because already from the real investment scheme, the company they invested in must prepare the account and deal with the tax issue there. Then another exemption is small companies. The law says small companies must not suffer withholding tax. The same way you are exempted from VAT and company income tax and education tax. Manufacturers and agricultural businesses, agro-allied, they are exempted also, so that the company can boom and they'll be able to survive the business terrain. So let's quickly look at capital gain tax. Capital gain tax now, the rate is 10%, but from next year, the rate is going to be 30%, the same thing like that of company income tax. Capital gain tax is paid on property, gains on property like building, property like charters, property like buildings and vehicles. Government want to earn something from whatever gain you made on capital, especially asset. So tax paid on the profit is not on the sales figure. So the question is, how do I calculate or how do I determine my capital gain tax to be paid? Capital gain tax is derived by establishing the cost of that asset you want to sell. Then you look at whatever expenses that you incurred to bring it to a sellable condition, the transfer expenses, the legal expenses, valuation expenses, or you engage the services of architect, accountant, you had everything together, and you add it to the cost. You will now deduct it from the selling price. So if the selling price is lesser than the cost plus all the expenses, you have nothing to pay. But if the selling price is above the cost with addition of all the expenses, then you pay 30% of the profit. So that is how company capital gain tax is arrived at. But we have some exceptions. The law says from year 2026, any sale of personal residential apartment, personal one, is exempted from capital gain tax. The pension funds, their exempted from capital gain tax. Sale of up to 2 personal vehicles. So if I have like 4 vehicles and I decide to sell 2 within the same year, if it is not above 2, those 2 vehicles are exempted from capital gain tax. But once it is up to like 3, then the third one is taxable. So let's move to individual tax. I think a question came in now on that area. So individual tax is broadened into 2 dimensions, the payee and the direct assessment. Payee is being paid by the employees of an organization. The law says once you have a staff, even if it is 1 staff, you must register that staff with the state internal revenue service. Some people may be saying, "No, I didn't have more than 2. I didn't have more than 3. It is when I have 5 staff." No, if it is only 1 staff that you have, that person must be registered with the state internal revenue service. Payee is different from pension and is different from ITF, Industrial Training Fund. But if you look at pension also, though the law may be say maybe 3 or 5 before you can register, but at the same time, it is very compulsory, because if I'm working with you in your organization, you must register me for pension, because if you don't register me, I will be at loss at the end of the day. And the truth is this: whatever job you want to bid for, contract you want to bid for, one of the key requirements is PENCOM compliance certificate. PENCOM compliance certificate. So if you have staff, why don't you register them? Register yourself, register your wife for voluntary contribution, so that at the end of the day, when you need to file any document for bidding, for contract, or for review, it will be easy for you. And for some of us that we have structured organization and you have not registered for pension scheme, I believe these are some of the areas the government will be putting their eyes on again. All right, so let's move on. The next one is, so the law says that once you register your staff, the DOTS is the state revenue that will do the computation. Just give them the name, the details that they needed, give them the gross pay, they will do the computation and they will give it to you. So once they give it to you, every month you must make deduction, and on or before of the following month of that payroll, you must file that payee. The next one is the direct assessment. For employer of labor, you fall under this because the law believes that your task as an employer of labor, as the CEO, MD, owner of the business, promoter of the business, your task cannot be fully determined until the end of that particular year, because they believe that there's some allowances that you'll be entitled to. And even if you're on payroll, okay, let me say something. We have some people that will say, "Oh no, let me be on payroll even as a director." Well, law did not frown at this. It's permissible, it's permitted. But the truth is this: when tax authority come to audit you, after they have audited the payroll, they will still look at it that as an MD, if you place yourself maybe on 1 million salary per month, that's 12 million. They will say, no, at the end of the day, beyond this payroll, there are some other things that you are entitled to that you'll be enjoying. So they will still come up with some additional tax liability, tax assessment, and they will ask you to come and pay. So I always advise our clients, put yourself on payee, on regular payee, deduct, remit. But for yourself, put yourself on direct assessment. And at the end of the day, I believe they have been enjoying such an advice. So, our determination of employers of labor tax liability, the same way that is applicable to the payee is also applicable to the employer, only that maybe there's some additional, for example, on the self-assessment or direct assessment form from the state internal revenue, especially Lagos State, they list different sources of income. Number 1, employment. Number 2, rent. Number 3, royalty. Number 4, then other sources of income. So they will aggregate all these together and now determine the tax liability. So what they do is they will invite you and they will ask you some questions, ask you to come with some documents, and they will assess you based on the questions and your response, and now come up with additional liability. But rather for them to sit down in the office and determine unnecessary liability, it's always good to have a tax consultant that will interface between you and the tax authority, and at the end of the day, we'll be able to come back home and come to give you a good assessment rather than allow them to slam you with unnecessary liability. There's something they call Form H1, which is expected to be filed by employers of labor. I believe by the end of this year, stroke early January, you'll be hearing the jingles from Lagos State and some other states. And what they'll be saying is, as an employer of labor, file your annual returns, both of your staff and yourself. For your staff, the law says you must file on or before 31st of January. Failure to do that is 500,000 naira. And for yourself as a director, the law says that you must file your annual returns on or before 31st of March by next year. So why do they give you the extension to 31st of March? They believe that since you are not on payroll, they give you like 3 months for you to determine your total income and make payment and file the same with the State Internal Revenue Service. The law says that if you fail to do that for yourself as an employer of labor, the penalty is 50,000 naira. So let's quickly go to the relief as far as personal income tax is concerned. Anyone that is earning below 800,000 or not more than 800,000 is tax exempted. That person, that individual is tax exempted for that particular year. So currently, there's something they call consolidated relief. Consolidated relief is being applied against your gross income to determine the chargeable income. But going forward from 2026, there is nothing like consolidated relief. The only relief that we have is on rent. And the maximum government is giving to anyone is 500,000 naira. So if you are earning, if your company is giving you 1 million naira or 2 million naira annual rent allowance, the law says that the maximum government will be given to you is 500,000 naira, and the remaining 1.5 million is chargeable, will be added back to other allowances and the basic salary to be taxed. So it's either 20% or 500,000, whichever is lower. So if, for example, you are given 1 million naira rent allowance in a year, 20% of it is 200,000 naira. Even though government say they keep it at 500,000 naira, they will give you 200,000 because 20% is lower than the 500,000. So, but if you are earning a rent allowance that the 20% is above 500,000, government will keep it at 500,000. That is the relief. And of course, if your company has pension scheme, NHF, and National Health Insurance Scheme, all these things too will be deducted before your tax is computed. So going forward from next year, going into pension is your money, and you can have access to it. When you lose your job and you have evidence that you lost your job, you can have 20%. You can have access to 20% of your total contribution. When you attain the age of 50, you can approach. When you attain the age of 60, you can access, and the balance will be converted to annuity, and you can be having something to collect every month. So it's very, very important to have it. If you don't have it, your gross salary will be taxed. But if you have all this scheme aside the rent relief, you will enjoy some certain relief. And at the end of the day, you are still the beneficiary of those national statutory deductions and remittance. All right, so let me conclude. Now, government came up with new rates. Currently, we have tax rates 7%, 11%, 15%, 19%, 21%, 24% applied. Time will not permit me to go into the detail. And the new data to be applied by next year, the first 800,000 is exempted from tax. The first 800,000 is exempted from tax. So anyone that is earning below 800,000 or not above 800,000, they are exempted. The next one is 2.2 million. So if you are earning 2.2 million, 1.8 million, if somebody is earning 150,000 in a month, at the end of the year, it's 1.8 million. So rent relief of 500,000 will be knocked out. So if the company is on pension scheme, national health scheme, national housing fund scheme, those figures too will be expunged before they arrive at chargeable income. And whatever resultant figure left, 50% will be applied on it. And the next one is 18% that fall into the category of 9 million. But the question is this: how many people earn up to 9 million in Nigeria? How many? I'm talking of the employees. So, as an employee, for you to be able to enjoy tax relief, you know, your company, your organization may do that. Advise the State Board of Internal Revenue, and they will give you the computation. But when they come for tax audit, they will need evidence of your receipt. So I said that going forward, when tax officer come for tax audit, they will ask you, give us the rent receipt or rent agreement of all your employees, so that we'll be able to know whether they should be given 20%, that 20%, 500,000, 300,000, as the case may be. So if you want to pay your rent next year, or you want to advise your clients next year, as they are making their payment, please get your receipt or your tenancy agreement intact. It's part of the documents to be used when it comes to tax audit from next year. Although the tax audit against next year cannot come earlier than 2027. So let me quickly say something about tax audit so that I can close and the other person can come up or to give room for question. Tax audit is being carried out by Federal Revenue Service, which is going to be Nigerian Revenue Service, any moment from 1st of January next year. And the State Internal Revenue Service, for example, for Lagos is LRS. So both revenue carry out audits. Why do they carry audits? Number one, to check compliances. To check compliance, is the company complying with the stipulated laws, Tax Act. Number two is to educate. So when a taxman comes to your office to audit, the first thing they will tell you after they have introduced themselves that we have come here not to witch hunt, not to kill your company, not to destroy your company, not to create terror, but we have come to check whether you are complying. And if you are not complying, to educate you. Then after the education, what next? They would determine the shortfall against the government, whether federal or state. So when they determine that, they will now raise additional assessment. But a good tax consultant will have discussed with them that, please, whatever thing that you come up with before you file it, please, as a professional colleague, give me the honor to check, review before you submit, because once it's been submitted, it's going to be worked upon. And based on my experience, whatever the TAMA or whatever the tax authority computes on the fee, by the time they are giving you the tax liability or demand notice, in fact, they can even jack it up to times 10 of whatever they gather on the fee. So what they are trying to do, okay, if you are not, because they want to make money for government, and if you are not satisfied with what we have come up with, we need to give us evidence. Give us thorough evidence. And please, let me say this before I close. If there is anything you need to work upon by next year, is documentation. It's very key. I listened to one of the clip by Taiwo Oyedele, the chairman of this reform. And they were saying something about repatriation from the diaspora, people that live in abroad are sent phone home. And the conclusion of Taiwo Oyedele is that let there be proper documentation and proper narration. Such money will not be taxed. Some people are thinking that, oh, government will just pull into my account and they will tax whatever that is there. Nobody has the power to tax what is on your account. The only thing they can do is to, after you are fired, is to write you officially and tell you that they are not satisfied with what you have filed, or they want to review your document. So after they have done that and they raise additional assessment against your company or against yourself, and you refuse to respond, you refuse to attend to those queries, and they have written you, and you refuse to respond, then they have the liberty to upload whatever liability into that tax promise. And Taiwo Oyedele was saying that they have access to the bank. What they will just do, that same amount that you have failed to resolve at the right time will be debited against your bank account. If you remember Dory Fowler era, he came up with VAID, that's voluntary declaration of assets. And a lot of people were brought into TaxNet. At the same time, there were a lot of incentives and relief given to them. Once you declare your position, go and pay it, and the liability, the penalty, late submission penalty, and interest will be waived. But a lot of people still not comply. And I know some clients and some people that are close to me that called us that they placed lien on their accounts. What they did then, if you have like 10 million, 50 million, 50 million, they will place lien on a particular amount that you can. For example, if you have like 30 million, they can place lien on 10 million. and the remaining 3 million, you will have access to it. And you will not have access to that 10 million until you resolve your tax position with them. So and I believe that is part of what the government will be doing next year. Oyedele was saying that the era has gone that government will be chasing people all around with stick. They will just look at your account and slam and debit the account with the tax liability. But I believe they can't just go ahead like that until, except you refuse to do what you're supposed to do. So once the additional assessment is raised, you can resolve it by providing additional evidences. And that is why I said documentation is very key. What to buy, purchase for production, purchase of raw material, and let the invoice tallies with what narration that you are made. So the era of purchasing without getting invoices is gone. Get invoices for virtually every purchases that you made. And whatever fund that flows into account that is not part of your business, note it. Even if there is assessment against it, and you have evidence to prove, then it will be knocked out. Then interbank transfer. If you have multiple accounts and you move money from one bank to the other, it's not taxable. It's still cash within the same organization. The only area is when you have multiple companies and fund or a transaction flow within themselves. That is where the issue of transfer pricing equally comes in. Transfer pricing is another discussion for another day. For those people that have different company, especially multinational, and they offer services and they sell products within one organization to the other organization. Then, after you have resolved that, you negotiate on the capacity to pay. Then the tax officers too, they have human fees, and they are not ready to kill your organization. You have raised 10 million naira against my company. I've provided enough documentary evidence, but you are saying no. You want to, what you want to give to me is 5 billion naira. At the end of the day, then you can still talk to them. You will kill this organization, and they can look at one or two provisions in the law. They can look at some other areas and probably reduce it at like 2 million, 2.5 million, and you are good to go. Then before then, okay, after that they will now give you letter of intent. That is from Federal Revenue, which is the same thing as Nigerian Revenue Service. If they do any audit, tax audit for you, and they have not given you letter of intent, and you pay, you are paying on Sarah. The evidence that you can have that a tax audit from Federal Revenue had been genuinely carried out, you must receive LOI, which is the same thing as letter of intent. Whatever that is on the letter of intent, and you pay that figure. If the audit is for 6 years, it closed. The audit for that 6 years is forever closed. The only reason they can go back to it if they suspect any fraudulence, any money laundering. For example, I had the opportunity of consulting for some companies this year. FRS, what they call EFCC wrote them, and they gave the reason why they wrote them: money laundering, that they did tax evasion, and they can audit them for as many years as possible. So that one is on exceptional cases. They might have done the audit, but if they discover that there are rooms for investigation, maybe fraudulent, money laundering, and whatever, or they have an intelligence on your company, they can carry out special investigation. But aside that one, once LOI is raised and you pay for those relevant years, the audit for those periods, they are closed. Now, let me quickly say something on this. Where probably you must have received a letter from FRS. They will tell you that they want to do a review If you file your account, I know that there's some account that we file within the following week, second week, they will write the organization and they will copy all that. They want to review the accounts that have just been submitted. Account review is different from tax audit. If they review your accounts, whatever they raise against you, and whatever something that you use to pacify, I don't want to use some language here, whatever that you use as sacrifice to pacify the door-to-door detention is different from real tax audit. So we have some organization that if they write them, we just approach the tax office, we prefer you to come and carry out the audit. So would go ahead to do the audit, and some people say no, we need to do the review first before the audit. So whichever one just know how to manage the situation. But for Lagos State or Internal Revenue Service, State Internal Revenue Service, what they call their own is not letter of intent, is final demand notice. So once they raise final demand notice for you and you pay, that payment closes the year under review when it comes to tax. Make a payment and document. After this, you make the payment and you document your payment. Final notice, final note or final advice. Again, keep proper documentation. Don't give tax authority the room to slam you with unnecessary liability. Thank you for listening. God bless you. I'm through. Coordinator, Adeze.
Very much, sir. That was a very insightful one. Thank you so much, sir. I think we've really learned a lot. I don't know if we have questions because we're a little bit far behind time. So, sir, sir, you still active, sir? Mr. Ino, sir?
You said?
Okay, I wanted to be sure you are still online. Maybe you could just quickly touch like 2 questions, then before we proceed, then we may now come back to the question at the end. There is a particular question here that says that what are the implications itself for startups, especially these new SME startups?
I barely hear you. Okay, can I read some here and quickly address it?
Moderator, why not allow the presentation to be done so that at the end question can come, because it's possible the second presentation may answer some of the questions.
Yeah, overlapping. Yeah. Maybe, but
okay, sir, that will be better then. Maybe we just hold on so that we can answer all questions at once. I think I agree with that. So we'll be going straight to the second presentation. So the questions will come after the second presentation for our listeners. We're going to have our next presenter. Our next presenter, of course, is going to be no other person than Dr. Dick Erie, who is an accomplished tax administrator and a fellow of multiple professional bodies, including the Institute of Chartered Accountants of Nigeria, FCA, the Chartered Institute of Taxation Nigeria, FCTI, the Association of National Accountants of Nigeria, FCNA, and the Institute of Chartered Mediators and Counselators of Nigeria, FICMC 2025. He holds advanced degrees in accounting management, including a PhD doctoral degree, and is an alumnus of Harvard Business School and the Harvard Kennedy School's Senior Executive Fellows Program. With over 3 decades, that's about 30 years of experience in banking, audit, and tax administration, Dr. Erie currently serves as the Coordinating Director, CD, Government and Medium Taxpayers Group, GMTG, Federal Inland Revenue Service, which we all know as FIRS. He has held numerous senior roles, including CD Enforcement, CD Enforcement Support Group, CD Compliance Support Group, Director Technical Department, and Special Assistant to the Executive Chairman of the FIRS, driving reforms and innovation in enforcement, compliance, and technical operations. He is a recipient of multiple awards. Dr. Iri played a vital role in the 2004 FIRS reforms that significantly advanced Nigeria's tax system. His expertise in leadership and strategy has been honed through participation in various local and international training programs. He has authored and co-authored many academic articles and books on topics such as tax practice, corporate governance, tax planning, tax expedition management, and contemporary issues in tax laws. Ladies and gentlemen, while you know that you're anticipating, please finally let's join me welcome Dr. Dick Iri as he takes us on the second.
Okay, yeah. So thank you very much.
Over to you, sir.
Yeah, thank you, Wisdom. And I want to also thank our first speaker, Mr. Ino Joseph. Thank you very much for the practical dimension of this presentation that you just made to us.
Thank you, sir.
Please permit me to specially acknowledge Ifedayo Owusheni, who met me on one of the social media platforms and contacted me, and from there we took it up to this level that I'm now making this presentation. I will be taking us through the tax reform acts that have just been passed into law that will soon be put into use from January 2026. There are 4 acts. The Nigeria Revenue Service Act. By the act itself, it said it was supposed to take effect 26 June 2025. The date was signed into law. The Nigerian Tax Administration Act, which has a commencement date of 1st January 2026. The Nigerian Revenue Board Act, which has a commencement date of 26/6/2025. And Nigerian Tax Act, which has all the law that also have a commencement date of 1st January 2026. But for convenience and administrative purposes, all these 4 laws, the government have said they will take effect from 1st January 2026. So for purpose of reference, the acts are referred to as Acts Nigerian Tax Act 2025. But the institute have decided to choose the new tax law 2026. But the most important thing is that they are all taking effect 1st January 2026. What are the objectives of this presentation? 3 things. 1, I will list some of the major changes that have been introduced by the recent Tax Reform Act. Next slide, I will also explain the implication of these changes for the general public, as many that are on call this evening, and perhaps also develop a compliance checklist that you need to take note in a bid to be tax compliant. Next slide. What are the historical challenges that we have faced? Ideally, we expect a harmonized tax framework with clear coordinated mandate. Government 3 tiers means the federal government, the state, that's the subnationals, and of course the grassroots, the local government that we run in Nigeria, that's the federal system that we run. But what was the reality that was confronting the country? In Nigeria, the pillars have historically been weakened. All these pillars that I just mentioned that are supposed to be the ideal state have all been weakened by fragmented legislation. In fact, there was a time that every year we were having what we call Finance Act, and they were amending the tax laws in piecemeal, and they were fragmented all over the place. So the nation has struggled with a patchwork for tax framework marked by multiple amendments, parallel collection authorities, absence of harmonized taxpayer data, and high level of non-compliance. These are some of the sickness that plagued the country all these years that gave reason or the foundation for the tax reform that we are speaking to this evening. Next slide.
Please, we can't hear anything again, no, please.
Guess he has a network issue. Let's just hold on.
Okay, can you hear me now? I'm back, please. Sorry.
Yeah, we can hear you, sir.
Yes,
Yeah,
we can
Okay,
hear you.
we can hear you, sir. You can proceed, sir.
Sorry, I didn't muted myself. This statute, as I said, there are three things that they brought to bear. One, they are now coordinated into one single document that we can lay hands on. Two, they are rule-based. The rules are very clear. Once you understand them, it's easy to comply. And number three, they are going to be technologically driven. As our Tunji just rightly mentioned to us, technology is going to be one of the key things that's going to drive this tax reform going forward. Next slide, please. What are the key challenges that we face before this tax reform? Next slide. Number one, there was this problem of multiplicity of taxes and levies. So many taxes, so many levies, and of course, I don't want to dwell here much because some of them are common knowledge that all of you are aware of. You are driving on the road, you see some people with policemen with a reflective jacket, and they will put nails and stones on the road to block the road for you. And these were illegal, but they were doing it, and they were getting away with it with even law enforcement agents. There was also the issue of inconsistent taxpayer database. You see different revenue agencies having different taxpayer database, different IDs. State will have their own, federal will have their own ID, and it was a challenge. Number three is that there was weak coordination. The joint tax board, for example, was just like a toothless bulldog. It could just bark, it could not bite. And that was the type of problem we had then. There was also fragmented revenue administration and dispute. Of course, as we speak today, you are aware that there's still a case in court of who has the right to collect VAT. Rivers State went to court, Lagos State joined, some other state joined. Even as we speak today, in Lagos State, you pay VAT, and at the same time, you pay what is called consumption tax or residency tax, whatever. I lodged in a hotel last week in Lagos, and I saw the bill. There was VAT. There was also another residency tax of 5% and the rest. So these are the issues that we face that the tax reform has come to address. Number 5, there was uneven enforcement and compliance system. people, there was no uniform way of complying with all this tax law. Now, what is the transformative journey that we have embarked upon as a country? I need to tell us that one, about 13 existing tax laws were repealed with this new tax reform. Next slide, please. About 13 existing tax laws were repealed, and another 13 tax laws were amended before we arrive at what we have today as the Nigerian Tax Act. And what is the goal? Just to simplify compliance and enhance clarity and ensure coherence in the tax system. You have all the tax law in one document. It's easy to carry, it's easy to refer to them, it's easy to go through them. And they all have the commencement date of 1st January 2026 going forward. That's the timeline. Let's please move forward about 2 slides for me. 2 slides. Yeah, that's what we stop here. Now, this is what the government aim to achieve. And this have been repeated severally on all the presentations that have been made and enlightenment that have been carried on. The focus of this tax reform is to ensure that those who are coming up are given breathing space to grow and mature to the point of bearing fruit. So the government is looking at only taxing the prosperity, those that have the ability to pay, those who are matured in their businesses and they are now producing fruit. And that is what the government is concentrating on. Next slide, please. Next slide. So these are the 4 tax laws that we have. The legal framework that was put in place for us. We have the NTA, which is the Nigerian Tax Act. This one embodies all the taxes that need to be administered, whether petroleum, whether carbon, hydrocarbon, value added to, profit related or gain, whatever, all the taxes that need to be administered, they are all embodied in this document. Then we have the Nigerian Tax Administration Act. This one talks about how to administer the taxes. Is it talking about registration? The procedure is here uniform, both for federal and for the states. Are you talking about filing of return? The procedure is also uniform all over the tax or the federation. Are you talking about payment of tax? The procedure and the processes, they are all embodied in this Nigerian Tax Administration Act. Then we have the Nigerian Revenue Establishment Act. Here, the government have put together, there's one change of name for the current federal agency that our brother was referring to, because he also mentioned it that this is talking about what is current. Before we transit, the Federal Revenue Service is now changed to Federal and Nigerian Revenue Service, Nigerian Revenue Service Establishment Act. Then we have the 4th one, which is the Joint Revenue Board Establishment Act. What this simply did is to give the current Joint Tax Board teeth and power to back and bite. Not only that, also to be able to coordinate and harmonize all the operations of the 36 plus FCT Internal Revenue Service operation. Now, let me take a deep dive into each of these tax acts that have just been passed, the 4 acts. Now, taking Nigerian Tax Act, the Nigerian Tax Act, it consolidates the company income tax, the personal income tax, capital gain tax, value added tax, stamp duties, and excise duties. It also harmonized something like the petroleum operation, hydrocarbon tax, are now all in single in one place. Then, of course, there's strictly it's focused on strictly tax charging provision. What are the taxes that you should, how do you charge a company income tax? How do you treat a personal income tax? This just is the charging provisions of all the taxes and the rule that we need to follow. They are all in the Nigerian Tax Administration Act. Next slide, you see the taxes that were repealed. When they repealed, these ones have been removed completely and have been replaced. They have been removed completely and have been replaced. The next slide, you see the taxes that were amended. The section, a portion of each of these 13 laws were all amended. And for want of time, I will not bother to read them to you, but you can see them on the screen as they are displayed. They were all amended, 13 of them. 13 were repealed and replaced, and 13, portion of these 13 were amended to form the Nigerian Tax Act. The next slide, you see the rates and the allowances. The rates and the allowances. For small company, and the definition is a bit, they have slightly two definitions, but I think government have a particular one in mind. For small company, the rate is 0%, starting from January 2026. Then for other companies, the rate is 30%. For small company, the Nigerian Tax Administration, Nigerian Tax Administration Act defines small company as any business that earns gross turnover of 100 million or less, 100 million or less, or has a fixed asset that is less than 250 million naira. That is for small company. That's how the Nigerian Tax Act Administration define it. While the same small company was also defined in Nigerian Tax Act as any company that earns gross turnover of 50 million or has a fixed asset of less than 250 million. But ideally, I'm sure these are some of the things that they will need to harmonize. The focus is the Tax Administration Act, which is 100 million. So we run with that, which is more favorable to the taxpayer, because when there's conflict, when there's disagreement, it's the taxpayer that always have his way. Capital allowance, my brother have explained, I don't need to waste my time on it, but I want to add something to the personal income tax minimum or exempted 800,000. The 800,000 is not the gross income that you earn. It is the net income after allowances have been deducted from your income. So if you look at the table that is on your right-hand side on the screen, you see first 800,000 at 0%. What it simply means that this is what we call chargeable income. Chargeable income is the net income after allowances have been removed from your gross income. And if it falls within 800, first 800 is to be charged at 0%. That is almost exempted. Then others, the rates are there as on the table. I'm sure for those of you who feel, who register properly, who indicated your email, this slide probably will be emailed to you for further scrutiny and further study and reference for future use. The next slide, please. Can you move on to the next slide for me? Here, this is the small company definition that I just gave. It's here stated clearly. And we have adopted in this slide the Nigerian Tax Administration Act, which is 100 million or less, or 250 million assets or less, asset not exceeding 250 million. But take note that there is a dimension to the definition of small company. Any company that provides professional services means service provided by an individual or a firm having specialized knowledge, like my brother, Tunji and Cole. They fall into professional service providers. They are not regarded, they are not going to be regarded as small companies in going forward from 2026. Next slide, please. Next slide here. Here we are looking at the PIT reliefs and allowable deductions. And my brother have taken us through them, so I will not want to waste our time here. We have what we call pension. The pension that you pay is a relief that will be deducted from your gross income. National health insurance that you pay is also a relief that will be deducted from your gross income. Life assurance premium that you pay for your life to secure your life, they are all relief that will be deducted from your gross income before you arrive at chargeable income. Interest paid on loan used to develop or purchase and owner-occupier residential houses. The idea is to encourage people to own their dwelling houses. So whatever interest you, if you take loan to develop your personal dwelling houses, the interest will be tax deductible. Then rent, of course, you have explained it to a maximum of 500,000. The next slide is talking about the single levy that have been now fixed at 4%, what we call development levy of 4%. Before now, the education tax was 5% of accessible, 3% of accessible profit. We also had what we call NITDA, which was paid by certain industry, certain company operating in certain industry. So there was confusion in computation. But here today, starting from January 1st, we only have one levy, which is a 4%, development levy, 4%. And when it is computed on accessible profit, this is to be shared to all these agencies that used to have what we call earmark taxes. Earmark taxes. They are all abolished now, and they have been amended, and this is what this side to be applied. The table below is showing how the one that goes to defense and security will further be applied to all the agencies that carry out defense and security. You know, you agree with me that security is a major issue in Nigeria. And the next slide is talking about the incentive, what we used to have as various incentives like pioneer status and others. They now call them economic development incentive, and here to be given to priority sector for the first period of 5 years, and which could be extended to another 5 years. Another 5 years if you are qualified, if they see that what the first 5 years was well utilized. The next slide. Here we look at the VAT reforms. What are my brother have mentioned, Itunji have mentioned it, that before now, your input VAT on your running costs were not allowed. They were taken as part of your cost. And if you have input VAT on assets, they were also taken as part of the cost of the asset. But going forward, they are going to be able to claim your input VAT on every item, on every of your expenditure, as long as you have documented evidence to support your claim. And of course, zero return have been expanded to include the food, medical, books, electricity, tuition are now zero return. Zero return simply means that the VAT you paid on the input is claimable by you, and it's claimable by you. And claim for VAT now, refund is now 30 days, and you are not expected to go through audits as it used to be before now. Then cost recovery is the business selling essential goods can now recover VAT cost, solving the previous issue of unrecoverable VAT inputs. Now let's quickly go to what are the deep dive into Nigerian Tax Administration Act. What are the deep dive? Now, what this act has brought to bear is that issue concerning registration, there's now mandatory registration for all taxable persons. There's what we call tax ID. Going forward, instead of having multiple tax ID that we used to have, we used to experience a federal inland revenue tax ID. You go to state, you have another one. You go to another place, say JTB ID. Now we are going to have one unique ID. For limited liability company, the plan is to adopt the ROC number. For individual, the plan is to adopt your NIN, NIN as your ID. So these are the two ID that is going to be in use going forward. And it's very easy for every company that's incorporated in CAC, you have a registration number. For individual, you must have your name, which is normal. And all these things have been linked with either your banking or whatever. So it's easy. Instead of having BVN, so many ID, we are going to have only one going forward. And for you to achieve this, it's going to be handled by technology. Number two, tax agents. The tax agents, that's people that carry out, that serve as intermediary between you, the taxpayer, and the tax authority, are now going to be accredited by the revenue authority. Refund now is now in twofold. For audit-based refund, that as company income tax refund, it will be done within 90 days. But for value-added tax, if you have any refund, input VAT claim, it will be done within 30 days. Then we have what we call advanced ruling. This is for big companies, not for small companies. And of course, one point that Tunji mentioned, I need to emphasize here, is that record keeping is going to be mandatory, and it will save you a lot of headache. If you play with record keeping, you probably be putting yourself in a very tight corner going forward. Now, the next, the record keeping here, the issue about how long should the record be kept, and what are the various provisions that are there. Proper books. Taxpayer must keep proper books and records to determine taxable income and tax payable. It's very important. Whether you are using manual system to keep your record, let it be well documented. This is my income book, this is my expenditure book, and all your receipts, please file them so that you save yourself hassles. Then flexibility of record may be kept in electronic or physical form. If you like, if you are a type that's very good in ICT, you can keep them in computer, back them up in whatever form. Then record, make sure you can keep them for a period of six years, because that's the legal lifespan of any record for assessment that can be raised on you. Then, of course, let your record be accessible when anytime they ask of them, you should be able to produce them. Penalty for failure to keep record is here. I will not dwell on it much because there are various, more than not only record, there are so many penalties, sanctions that can be taken against any taxpayer that fail to do the needful. So now the next slide is talking about the consequences for failing to do the right thing. And this is what I think we should take note. Next slide, please. The consequences of failing to do the right thing. Without a good record keeping, tax knowledge, and proper filing, business may, one, file incorrect return, and there are sanctions for filing incorrect return. Number two, you may also miss deadline and incur penalty. Deadline for filing return, deadlines of making payments. If you don't have accurate record, you are going to run into this type of problem. Number three, you'll be unable to defend transaction during audit, just as our brother explained to us, Tunji explained to us. You'll be unable to defend your transaction if you don't have adequate record, you don't have a file to keep all your receipts that you have incurred costs on. Then you will lose out on deductions and incentive. What is rightfully due to you, to your business, you may lose out of them. Then number five is that you will face difficulties assessing credit or attracting investors for your own business growth. So good record equals to legal protection plus better decision making, and of course tax savings. You go to the next slide. Banking sector obligation. These have been discussed by my brother. But just to mention that the bank have obligation within that quarterly to make return to the Revenue Authority on a certain threshold of whatever. The idea, the rumor that is going on that, oh, they will, whatever money that's in your bank, they will tax it, is not correct. And Tunji have actually explained this, and I don't want to waste our time on it. Nobody's going to take your money without your knowledge. Garnishee order can only be applied to you when there's enforcement against you. Then next slide, please. It's important for us to take note of this, because this was one of the major contention that was almost going to throw the whole tax reform into chaos. That is the VAT sharing formula. The federal government, what it did was to reduce what they were getting. They were getting 15% of every VAT that was collected, but they reduced it to 10% and moved that 5% to the states. So the states now have 55% of every VAT that is collected in the country by Nigeria Revenue Service going forward. The local government still retain the 35%. But one of the things that we need to take note is that the state and local government sharing formula have been adjusted a bit. What we used to know as derivation is now consumption. And truly this represents what VAT is. Value-added tax is a consumption tax. And so consumption should be one of the key bedrock in determining how VAT should be shared among the whole, the people, the beneficiaries. Then process improvement. There's unified payments, aligned due date for all transaction taxes. They are all aligned. You used to have 30, some 21 days, some 30 days, but now they are all aligned. They have the same due date. Consolidated penalty, the penalties are the same. If you fail to file, so penalty. If you fail to pay, so penalty. It's not different penalty and different this thing. Then every MDA that failed to have collected government money and failed to remit, the accountant general have been empowered to deduct such money that they failed to remit from their allocation that is due to them. What is the new thing that we need to take note in Nigerian Revenue Service? FRS is now being transformed or transiting to what we call Nigerian Revenue Service. The focus of this is to establish the Establishment Act focuses solely on the creation and structure of the service, just the creation and structure of the service. Now, one of the things that has come to bear in this act is that there's more collaboration between the federal agency and the state and local government. Any of them can ask for assistance. Any state government can ask Nigeria Revenue Service to help them in if they feel that they don't have capacity to handle any aspect of their function. They can ask any of this, ask the federal agency to help them. The truth is that federal agency have actually advanced more than any of the other states, except Lagos, which have also can boast of good IT base. Then the Joint Revenue Board. Next slide. Joint Revenue Board. Next slide. Here, the board replaces the Joint Tax Board. The Joint Revenue Board replaces the Joint Tax Board. And now it covers both the federal and all the state tax authority. Number two, the Tax Appeal Tribunal, which was has now been established. And one thing that we need to take note is the establishment of an office that never existed before, the Tax Ombudsman. This office is established to ensure that the taxpayer or the public have a point of complaint where they can go to without incurring any cost. Before now, if a taxpayer have any complaint, he approach the Tax Appeal Tribunal where he will incur costs. He has to take a lawyer. He has to incur costs of defending or making his case. But there's now a free body known as the Tax Ombudsman. Any taxpayer that is aggrieved, that is not properly taken care of or wrongly maltreated, can lay complaint to this establishment, and they will investigate and resolve the matter amicably. So that's a plus for Nigeria for the first time in Nigeria. Now, in conclusion, what are the next steps? The 2025 Tax Reform Act offers a modern, consolidated, and tech-driven fiscal framework. Take note, tech-driven. Data is going to be a major source of driving the tax laws going forward from 2026. So staying up to date with the reform and engaging professionals where necessary is very key for you. And our brother mentioned it, very, very key. You need to engage experts who will help you to navigate some of these things and also and give you better understanding of the tax law. The system upgrade and digital infrastructure is something that have taken place in current FRS as the transfer, as the transit to the Nigerian Revenue Service. Then we also need intensive education and engagement. A lot, this is what this institute have come up to do. The Chartered Institute of Sales and Consumer Management. Now, this is what they are doing now to educate the general public and also help them to ensure that they have good understanding. So on this note, I want to thank you all for your time and for listening to me, and especially the institute that brought me up to come and speak to you. Thank you very much, and God bless. I wait your questions. Thank you.
Thank you very much, sir. Thank you for you've really done justice. I'm sure many of us have been blessed with series of knowledge. Many of us already have our questions bothering our minds being answered. But today's lecture concerning 2026 tax laws. So can we have questions in comment sections? And if you would like to actually ask your question in person, you can just raise up your hand so you can be called upon. If you have questions for any of the speakers, you can just raise up your hand. Just signify so we can have you ask your question.
Hello, good evening.
Yes, go ahead, Kingsley.
Okay, good evening, Kingsley. We can hear you.
Yes, I want to appreciate our two facilitators. These are excellent men with so much, knowledge in what the discourse of today. Thank you so much, sirs. I deeply appreciate every one of you. But for our first facilitator, sir, you talked about the CFO, the CEO, having something around direct inversion. I've forgotten how you put it, instead of just doing a payee thing. Can you throw a little bit more light on that angle? Give a clarity on that so that we know how to follow that this thing. We can actually consult you on that. Thank you so much, sir.
Okay, thank you, sir. And thank you, Doctor, for such a powerful presentation. I really appreciate.
Thank you.
Yeah. So I said something about an employer of labor, a director, a CEO, a business owner being on direct assessment. There is nothing stopping you putting yourself on payee scheme like that of your staff, because the same rate is still applicable upon your income. But the timing difference is key. At the end of the day, when you put yourself on payee, on payroll, the government, if they come for tax audit, they will just take that one as purely income on your employment. And I said that in the direct assessment form or assessment form, aside employment, we have realty, we have rent, we have other income. So rather than facing like two orders, it's better you just go for that direct assessment. So when you go for that direct assessment, you know that it's just you'll be assessed once, and you will not be paying. There will not be any room for maybe additional assessment for you. You know that you are just facing the tax authority once, and at the end of the day, you can even get something lesser when it comes to assessing you than you putting yourself on payroll and at the same time raising an additional assessment for you, because tax authority will never believe that it is only once you are earning on that payroll that is the final total income for you as a director. I don't know whether I've been able to address the question.
Thank you so much, sir. I appreciate you. You have really answered me, sir.
All right, sir.
All right, thank you, Kingsley, for that insightful question. We have some questions in the comments as well. Let's pick some questions in the comments.
My laptop.
So we have someone asking here. He said, when we tax, sorry, let me be clear with it.
Yeah.
Will the tax reform increase or reduce the overall tax burden on businesses? So
let my doctor answer, sir.
Come again. What's the question?
So doctor, sir, the question says that with the tax reduction, will it actually bring reduction on businesses?
Yes, I want to answer it in two ways, yes or no. Yes, in the sense that the threshold for tax exemption for companies have been increased. It used to be 25 million as at up to this 31st December 2025. But going forward, this has been increased to 100 million. So many companies are likely to be exempted from paying tax. And also individual, the chargeable income, which I said is the gross minus relief, it has increased to 800,000. So for as many that are within this band, their tax is going to be reduced, or if not at all, if nothing payable at all. But for why I said yes and no is that the yes is the no is that if you going forward, the revenue authority are going to rely more on ICT. And once they do that, they are going to pull data together. There's something that we call a single window now. Single window, which is not yet working. Single window, which is a window where all data that relates to import and export will be pulled together, and they can there will not be hiding place for any business that is involved in import or export. Whatever your transactions are will be available. Of course, Oga Tunji mentioned about e-invoicing that is currently going on, that fiscalization of a transaction. Every invoice that they are starting with the big taxpayer and a large taxpayer. After that, they will come down to the medium and come down to the small one. What it means that whatever transaction that takes place in your organization, the Nigerian Revenue Service is likely to have it's going to be visible to them by way of your reporting to them in advance. So before you put your record together, they can as well also put it together and show you that this is what information we have about you. And there's one aspect that is not too glaring, and I can say it here to guide us. Any expense that you incurred and on which you didn't pay VAT on, you are not likely to enjoy the benefit of deduction from your income. So take note of that. There's a section of the law. It's silent, but it's there hidden. And we need to take note. So any expense that is subject to VAT, and you know you're supposed to pay VAT on it, please pay it and keep adequate record of it so that you can easily enjoy the benefit of deducting it from your a deductible expense, a liable expense in your business transaction. So for businesses, because of advancement of upgradement in technology and data that is going to be available, and if you don't keep adequate record, you are likely to run into the challenge of paying slightly higher. For those who are doing good business who were hitherto hiding before, there will be no hiding place for them. That's the truth about it. I don't know if that suffices to explain some things to you. If Tunji
Yes,
wants
sir.
to add to
But very quickly, Doctor, so that you can add to that.
yes.
Doctor, sir, before you leave that particular comment, maybe you may want to comment on this question that says that how does the tax on rent apply to people who own their own apartments and do not pay rent? So you were speaking on we keeping all our receipt. How does the tax on rent apply to
the rent allowance that is given for personal income tax for purpose of computing personal income tax is the rent that you pay. Okay. Is the rent that you pay. So if you are living in your personal building, except you took loan to build that personal owner occupier building, then the interest that is due on that loan is what is exempted. That is what is liable as a relief against your personal income tax. But if it's a house that you have already built long ago and you are already enjoying, you are living in it, I'm not sure you have any relief for occupying your personal house. Thank you.
Thank you very much, sir.
Yes.
I
Yes,
don't know if Mr. Tunji also have comments on the questions that were previously asked.
Okay, Doctor, I said it all. Very precise.
Okay, good evening.
Yeah, Prince, go ahead.
Yeah, we really appreciate the way you dissect all the issue one by one, and we thank you for that, sir. My question now is, I'm as a retiree that have one or two property. Now that's what is living on. Are we going to pay tax on the money collected from the property?
There's which Tunji explained to us, I know about what we call withholding tax. Okay. And rent happen to be rent income happen to be what is subject to withholding tax. I'm not sure it has changed. Tunji, has it changed?
It has not changed.
So there will be withholding tax on your rental income. And
okay. Thank you very much. But is it going to come on percentage? Am I be the one to go and pay? Or how is it being how will it be deducted? Because they will pay directly to my account.
Ideally, it is the person receiving the income that's supposed to deduct that rent and remit. But practically between me and you and what we have seen in Nigeria is that most landlords pass that burden to the tenant. They say what you are paying me is net of taxes. So in fact, they even put it in the agreement that what you are paying to me is net of taxes. If there are any taxes, you are the one to bear it. So technically, the landlord have looked for a way to pass that burden to the tenant. But the way withholding tax system work in Nigeria is that the person making the payment is one that's supposed to deduct it from your rent and remit it to the the internal revenue if it's the property is in your individual name. And if it's a limited liability company that you use in building the property or you are collecting the rent, supposed to remit it to the Nigerian Revenue Service. But I'm sure most landlords, they pass that burden to the tenant and say, whatever you are paying me is net of rent. That's what we have seen in practical terms in Nigeria.
Okay, thank you very much, sir.
Okay, Prince.
Yes, sir.
We also have a question here. The
Go ahead.
question says that how can business name that is a sole proprietorship business, registered companies comply better and avoid high tax liability name or limited companies? How can they comply better and avoid high tax liability?
Okay, I will say something, then I will allow Tunji to also add to it. When Tunji was speaking, he was saying company, company, company. And my daughter, who wants to go into fashion, is sitting here with me. He asked a question that what of our own that is business name? I say, well, what Tunji is referring to is limited liability company. Now, for business name, the way it's treated in Nigerian system is like an individual. You are treated like an individual. You are getting a tax grant certificate written as Dick Iri trading as Dick Iri and Co. and company. That's how it is written. So whatever business name does, just like Tunji was explaining, whatever business name does, your operation is taken as your personal income. It's taken to as part of your personal income. When you are giving form by the Internal Revenue Service, they will ask you, the form will ask you to explain all those businesses that you run as business name and the income you derive from them, the expenses and the rest. So they expect you to also attach your account to it and be able to access it as your personal income that is due to you as a proprietor or as a proprietress. I don't know if Tunji can just add something to that too.
Okay, you have actually said the main thing. For business name, partnership, they say that profit, they say that the profit is being shared or is being taken by the owner of the business or by the partners within the partnership, unlike the limited company that pays company income tax. So whatever the profit at the end of the day, they have the understanding that the individual that owns the company or the partners, if they like, they can share the entire something, the profit, and start all over again. So they will trust the individual owners or owner of that company based on the profit declared. And that is why I said during the audit, they will ask you, after you have assessed yourself, and they want to go further, they will ask you to come up with your audited account. And they will now look at that profit. What you have paid, does it commensurate with the profit that you declare? So if it doesn't, they will now raise additional assessment. And that is why, as a business owner, when you are paying your tax, plan it alongside with your profit. After all, there are some expenses that you can run that will be able to tally with whatever you want to pay. I'm speaking with wisdom. All right, sir.
Okay, so let me add here that business name, if you are trading in vatable goods, you are expected to register for VAT. That's if your turnover is up to 100 million. If you are not up to 100 million, you are not even registered, you are not expected to register, you are not even expected to file value-added tax going forward. So you must track your turnover, your income. As long as it's up to 100 million, you know that you now fall into the duty of registration and filing and deducting VAT and remitting to the Nigerian Revenue Service. So for VAT, you need to track your income properly to ensure that you are within the threshold of 100 million, below 100 million. But once you are above 100 million, the duty for you to register and file VAT return falls on you squarely as a business name owner too. Thank you. Any other question, Wisdom? Wisdom?
Thank you very much. Thank you very much. I think I tapped out earlier. Thank you very much, Mr. Thank you very much, Dr. Dick. Because of time, I think this is this
Network. Your network is a bit bad. Wisdom, your network is very poor. We can't hear you at all. It's network. Internet. Can't even hear him at all.
I must say a very big thank you on behalf of this institution. Institute of
Mr. Wisdom.
And insight. For rest of this
Mr. Wisdom
summit, and trust me, next month is going to have. Hello, can anyone hear me?
Yes, Mr. Wisdom.
Hear me?
Yes, we can hear you. Yes, we can hear you.
We lost you at a point.
Okay. I said we would have loved to take one more question, but because of our time, we may have to round off. I was actually
Mr.
appreciating
Wisdom.
Mr.
Yes,
Wisdom, I can hear you, sir.
Sorry for interrupting you. Please, I will need you to take one question on the group that talk about the CAC and FRS tax. Please, can we just take that one? I'm so sorry, but I think that question is very vital for business owners. After that, we can close. Thank you.
What's the question?
He said, I have a question. The annual returns I pay to CAC platform, please, is it in line with FRS tax too? Or will I have to pay on CAC annual returns and also on FRS tax? Please help me.
Annual return by CAC is, I think they have their fees. It's a fee-based return that you're supposed to do every year. It's not ad valorem. It's not based on your income, total income or profit. But the tax you pay to Federal Inland Revenue Service. And by the way, annual return is both mandatory for both business name and limited liability company with CAC. But the tax you pay to either Federal Revenue Service or State Internal Revenue Service is a function of the profit that you make from your business that is subject to tax. And if it's a value-added tax, it's a function of the goods, the type of goods or services that you render, that you deal in, whether they are vatable or exempt. So these are just the two basic knowledge that I need to know. So annual return is just a fees base that CAC, Corporate Affairs Commission, require you to do every year. You submit your return to your account to them, and you pay a particular fee for keeping your company alive every year. You make sure that you are not delisted from their register. That is all.
All right. Thank you.
Thank you, sir.
Thank you, sir.
Okay, go ahead. Take over, Wisdom or Ifedaya.
Okay, good evening, everybody.
Good evening.
Good evening. Thank you very much, sir. Thanks very much, Dr. Dick. Thank you very much.
Thank
Mr.
you.
Tunji, thank you so much. Thank you, everyone, for joining. I think here we'll come to the end of the meeting. I'm sure we gained ample knowledge about our new tax law by next year. So
Yes,
thank you, everyone, for joining. Please, do you have we would like to have a volunteer that would take us in the closing prayer as we close the meeting? Anybody?
I can see Benga Ayodele raising up his hand there. Maybe he wants to pray.
Mr. Benga. Okay, anyone who wants to pray, please unmute and pray so we can sing.
I want to request I share my slides with as many that indicated their email can send to them.
Yes, we'll do that. We'll do that, sir.
Thank you.
Can I pray?
Yeah, go ahead.
Father, once again, we want to say thank you for tonight. Thank you for the knowledge shared. Thank you for how you have impacted us, oh Lord, even through the speakers. Lord, we are grateful. Please accept our thanks, Lord, in Jesus' name.